is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Mixed signals. The yuan fluctuates as China accelerates the easing of COVID restrictions, returning the focus to growth. Trade data, though, slumps. Sounding the alarm, U.S. stocks slide as banks warn about the gloomy outlook. Goldman Sachs Chief Executive David Solomon says job cuts and smaller bonuses may be on the table. Plus, big pharma surges after a big win as a U.S. court dismisses cases against heartburn drug Zantac, while GSK jumps the most in 25 years. Now, first thing is first, so let's check in on the market. And here, actually, we have a much more subdued picture. European stocks falling, bonds extending some of the rally that we've seen over the last couple of weeks. A couple of question marks over China. Chinese trade data compounded fears about the health of the global economy. At the same time, China is saying they will reopen. So investors don't really quite know how to interpret that. Is that a positive? Will we really get the reopening? And what does the trade data mean going forward for big trading partners such as Europe? For the moment, European stocks down 0.2%. The only, the stocks actually that I see in terms of industry groups losing the most is still basic resources and energy technology, down some 0.6%. And then you can see the U.S. dollar index. We're looking at the Bloomberg U.S. dollar gauge, 1,270. Again, recession fear is really palpable in a lot of pockets of the markets, certainly in the bond market, where we're also seeing a yield inversion hitting a 4-decade extreme, sending the 10-year rate in the U.S. This is probably my chart of the day, below those 2-year notes by the most since the 1980s. So watch out for any stress, watch out for that yield curve inversion. The picture overall, when you look at Europe, for example, the DAX is unchanged, the CAC is unchanged. Again, we're going into December 2023. We're getting a lot of economists coming out with what they're expecting in 2023. I'm seeing a lot of titles saying, look, if you thought 22 was bad, 2022 was bad, wait for next year. The FTSE actually gaining some 0.2%. Now, some positive news, probably not if you're one of the 5,000 that could have litigated big pharma, but certainly if you're an investor in, for example, Sanofi, GlaxoSmithKline gaining some 11% and 7.5%. This is after a judge in the U.S. rejected a case that actually linked Zantac, the acid reflux drug, to cancer. The other big story is Apple. So this is what it's doing pre-market. We did see, I think, already a move on Apple. We had our Aggie Cantrell looking at, okay, pre-market, it's not doing that much, so keep an eye on it, 141.83. Now, coming up, we really have a fantastic lineup of guests. This is who we're focusing on. We have the Naspers chief executive. We have Nouriel Roubini. I don't know if Mr. Doom and Gloom can be even gloomier than some of the inversion talk that we're seeing in the market. So that will be a good conversation on 2023. And then we look at possible M&A deals, the pipeline, banker bonuses as well, with Stéphane Boujnah, the Euronext chief executive officer. This is a pretty stellar lineup, so stay tuned for that. Now, China set to announce further easing of COVID measures as soon as today. It comes as the country's exports and imports both contracted in November as external demand continued to weaken and a worsened COVID outbreak disrupted production and cut demand at home. Now, for more, we're joined by Bloomberg's chief Asia economics correspondent. He is Enda Curran. Enda, what are the details, first of all, good morning, on these China COVID measures? How much will they ease?
So it's another 10-point plan from the central government. It includes measures such as allowing people who get sick to quarantine at home instead of a government facility. There are changes to underground testing rules. They're easing up on testing to get into public spaces, for example. So it's a whole series of micro measures that are being interpreted as another step away from COVID zero by the authorities. Now, this is moving pretty fast. A lot of people say are now changing their projections on when China will eventually exit COVID zero. It should be said, though, there's still a long way to go on this. China has several layers of restrictions, unlike any other country in the world. But there's a view that given where the economy is at, the pressure on the economy, and given, of course, the protests recently, that the government is now pivoting and that it's happening faster than was anticipated even a few weeks ago.
So, and when you look at the top lines for the November trade data, they didn't look good. Like, what are you expecting in 2023?
the trade numbers were definitely bad. And this again goes to the whole COVID story. Exports were slumping. That partly reflects weakening global demand. Imports were down. That reflects, of course, domestic weakness due to the ongoing COVID restrictions. And when you consider that exports, they're not a huge driver of China's growth anymore, but it was an important pillar in terms of China's economic recovery. That's now fading, and it's all feeding into this picture as to why China is pivoting on COVID. A lot of China watchers are saying with the economy in the space that it is, they have to pivot. They need to support the economy. The central bank came out this morning as well, by the way, with some commentary via the government that they will offer targeted and powerful support to the economy. So there's a change happening in terms of support for the economy, and there's a change happening on how they're approaching and handling COVID also.
And thank you so much, as always, for your brilliant insight and the current there with the very latest on China. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
The Democrats have narrowly retained Georgia's Senate seat, giving them an outright majority of the U.S. upper house. Senator Pangaea defeated Republican challenger Herschel Walker in the state's hotly contested ballot election, with nearly all ballots counted.
Yeah, I think, Leanne, I think actually I need to pick up. I think there was a sound issue. I wasn't quite sure if I was the only one not hearing you, but we will get more. Leanne was talking about Georgia, so we'll get onto that in just a second. Here are the rest of the top stories that we need to look at. So apart from Georgia, let's look at what else is going on. So we will see whether Georgia is definite of course, a Democrat state. Now, the European Union is set to proceed with 2 cases against China, the World Trade Organization, after talks failed to resolve the issues. EU Commissioner Valdis Dombrovskis says one dispute relates to restrictions on the Lithuanian exports, a second over what he calls coercive practices to limit patent holders from exercising their rights to protect innovation in court. Now, the UK has agreed to end an effective ban on new onshore wind farms, the second major climb down from the government in 2 days. Now, in the face of a rebellion amongst Conservative members of Parliament, the government has announced a consultation on letting local communities decide on new wind turbines. So we'll have plenty more on our top stories. Coming up, a tough year for tech. Prosus has valued its global portfolio of internet assets well below last year's $50 billion valuation. We'll talk to the chief executive of tech investor Prosus next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London. Now, we're now joined by Bob van Dijk. He is the Chief Executive Officer of Prosus and Naspers. Bob, great to have you on the program today. We know that it's a big day, of course, with some of the choices ahead, what it means for Prosus and Naspers. First of all, Prosus has a very large cash balance sheet, which is, frankly, any chief executive's dream. I know there's questions about when you'll be profitable and things like that, but what are you expecting to do with that balance sheet going into 2023?
You know, when times are a little bit uncertain or a lot uncertain, which I probably would be the way I characterize where we are now, I think it is actually a huge differentiator to have a significant cash on hand, because you never know how the recession that we are likely to face will develop. It's also an opportunity when you see asset prices are depressed. We have a fairly high bar for further investment, but it could provide us with opportunity. It's typically when there is significant change and uncertainty that opportunity shows itself.
Yeah, so where would you see opportunity, Bob? And I know we need to talk about Tencent and, of course, when you're expecting the group to be profitable, excluding your stake in Tencent.
Yeah, no. So we have a few real focus areas for the group. So we've been investing quite a bit in food delivery across the world, and we're by customers probably one of the biggest players in the world. And food delivery is an area where we actually recently done a significant further investment when we bought the remainder of iFood in Brazil. And I think that is a good example of the type of investments that we want to pursue, because it's what we think a huge return opportunity. It's also a business we know really well, and it's one where we're comfortable that the risks are limited. So the bar is high, and core areas like food delivery are important for us, as well as EdTech, where we have a significant portfolio. So probably more investments in the things we know well, where we see things that we believe have limited risk and are potentially well priced.
But how do you see, I mean, where do you see the potential, for example, for food delivery? I mean, we're looking at 2023, forecasts for the economy, they're ugly. Inflation could get worse and, people will have less money to spend. Like, what do you see as the biggest risk to 2023?
Yeah, look, you are absolutely right. There is definitely significant inflation. There is recession risk. We found that if you look at our businesses, we just announced results 2 weeks ago, and our e-commerce business growing at 40%. That is such a level of growth, and that's so far in excess of, say, the growth of the economy, that typically whether the economy grows plus 2% or minus 2%, doesn't really matter that much, because the online products that we focus on actually grow much faster than the economy itself. So typically, we might see some effects, but we expect strong growth ahead in spite of a tough economic environment. And we're very used to dealing with inflation, right? We've been operating in markets like Argentina and Turkey for many decades. So an inflationary environment is not a new thing for us to manage through.
Yeah. But Bob, are you expecting 2023 to be worse than 2022 in terms of economic outlook and therefore consumer spending?
No, I do think 2023 will be a tough year in terms of overall economic growth. I do also think that sort of the secular trends we've seen around people doing more of their activities online are ones that will continue in spite of times being relatively bad. And we also invest in an area called classifieds, which is typically around having people buy goods that already have been used, and that is actually counter-cyclical. So some businesses, of course, will be somewhat impacted, but other businesses will actually thrive in an environment where people feel the pinch.
Talk to me a little bit about, how do you see the quantifiable benefit of actually selling down your stake in Tencent and buying back your own shares?
Yeah, so it's been, since we launched the program in June, we created about $15 billion in value for shareholders, which we're obviously really proud of. And the discount has come down from sort of the mid-50s to closer to mid-30s. So it's been very impactful. And I think one of the things that is really important to emphasize is that because of the way the share price has developed, actually, by doing this buyback at a discounted level, our exposure to Tencent per share actually goes up. Strange mathematics, but that's the way it works. So per share, you'll actually get more of Tencent rather than less because of this. And we are huge believers in the future of Tencent, and actually very positive about China as well. And I think sort of the recent news that you covered today and that we've been expecting is actually putting that confidence even more forward for us.
Yeah, and I know, I mean, it's a little bit tricky to explain on live TV, but Bob, there's a discount, right? So there's been an effect on some of the process businesses being valued at a discount to the stake that you own. I don't know if it makes sense to all of our viewers, but I hope it does. When do you expect that change or that gap, I guess, to close, that discount?
Yeah. Indeed, it's basically, if you look at the combined value of all the assets we own and you compare that with our share price, there's a certain discount there. So that's the way we define it, and that actually has come down very substantially in the last 6 months, as I mentioned. And look, it's something that many companies that are diversified holding companies have, but it's a good sign to see that it's significantly come back from where it was.
All right, Bob, thank you so much, as always, for taking the time to speak to Bloomberg. Bob van Dijk, there, the Chief Executive Officer of Prosus and Naspers, joining us for an exclusive conversation. Now, coming up, Roubini Macro Associates Chairman and Chief Executive. He is the one and only Nouriel Roubini on his new books. Well, Mega Threat, it's one book, but I think he makes 10 points of what he's worried about. The 10 trends that imperil our future and how to survive them. That interview is up next, and this is Bloomberg. Well, Well, we will get in a second to the Bank of America Chief Executive. I think we spoke to Brian Moynihan. We had a great interview at the Goldman Sachs Financial Services Conference in New York. The main focus, of course, was that 2023. How ugly is it? And what does that mean for bonuses and also bankers' jobs? Now, in recent years, the world is facing, I know you know, facing growing risks not witnessed for decades, from wars to debt crises, pandemics to climate change, overpopulation to superpower rivalry. The list of challenges facing policymakers and leaders is daunting. A new book, Mega Threats, The 10 Trends That Imperil Our Future and How to Survive Them, seeks to summarize and find solutions to these risks. Well, the author of the book, Nouriel Roubini, Mr. Doom, I don't know whether we should call him Mr. Doom anymore, Chairman and Chief Executive Roubini Macro Associates, joins us now. Nouriel, great pleasure. Finally, we got you to the London studio. It's a great book. It's a bit of a depressing read, but at least you give also solutions on how to deal with it. Let's forget the doom and gloom for 1 second. Is there anything where December 7th, 2022, that you point to and saying, actually, it's a little bit better than expected, or it could be in 2023?
No, I feel that right now things are going in the wrong direction.
Yeah.
We're entering a recession in most advanced economies, starting with the United Kingdom and the Eurozone, also in the United States soon enough. And inflation is still too high. So we're entering a stagflation like we're not seen since the 1970s. But in the 1970s, we had negative supply shocks, but debt ratio, private and public, as a share of GDP, were low, 100%. Today, they're about 400% of GDP and rising.
Yeah.
So not only there's a risk of inflation and stagflation, also the risk of a debt crisis, because now central banks have to increase interest rates to fight inflation. So institutions, private and public, are insolvent, they're going to go into bankruptcy.
But we know this, right?
Yeah.
We've known this for quite some time. So I would imagine that the greater good, or at least leaders, are taking action to soften the blow.
Unfortunately, central banks are facing a dilemma, because whenever you have a negative aggregate supply shocks, either you raise interest rates to fight inflation and you cause a hard landing, and we're headed towards a hard landing, or if you do the reverse and you care about growth and jobs, you don't increase interest rates enough, then you end up with a price-wage spiral and a de-anchoring of inflation expectation. But on top of this trade-off, there is a new one, because today there are also issues of financial stability. There is so much private and public debt that the risk is not just of a hard landing as central banks are increasing interest rates, but also risk of a crash in bond markets and credit markets and creating tighter financial conditions that make the recession worse.
But this is what, Nouriel, so you're not talking, and really congratulations on the book. It was a great read, and I thoroughly enjoyed it. But you're not, are you talking about treasury, liquidity, or is it shadow banking? Because when you look at financial stability, it's not that banks will go under like 2008. It's other parts of the markets that are, away from, I guess, the more established financial base.
You're right. During the global financial crisis, it was mostly household debt and the debt of the banking system. Today is more corporate debt, the shadow banks that finance that corporate debt, leverage loans, CLOs, private debt, high yield, high grade, fallen angels. And now we have also the problems that in many parts of the world, sovereigns are so indebted that you can have a debt crisis. And we saw some of those signals, what happened the last couple of months in the United Kingdom, where reckless fiscal policy led to a sharp rise in interest rates and a fall of the currency.
Nouriel, when you look at some of the data out of the US and elsewhere, they're not as bad as expected. So is this a blip and you expect it to turn it really bad in 2023, or because of innovation, because of resilience, frankly also because of the pandemic means that people have adjusted, even supply chains, we could have a hard landing maybe on the softer side?
Well, now, until this year, people were saying there'll be a soft landing. Now the consensus is that it's going to be a hard landing, but it's going to be a short and shallow recession, maybe only a couple of quarters, plain vanilla, garden variety. I beg to differ. First of all, we're having a situation which, unlike the GFC and unlike the beginning of the COVID crisis, you are having to increase interest rates and have a tighter credit in a situation in which the economy is slowing down, going into a recession. Two, everybody's doing around the world. Three, the debt levels are much higher than they were 10, 20, or 30 years ago. And we don't even have room for massive fiscal stimulus. So I think that the conventional wisdom was wrong on believing that inflation was temporary, was wrong in believing it was just a bad policy. There were also negative supply shocks. And now they're saying there will be a short and shallow recession. I think it's going to be a severe recession. The other way I think that the conventional wisdom is wrong is they say central banks are committed to fight inflation at any cost. I think that we're not only in a situation of fiscal dominance, in a game of chicken between fiscal and monetary authority, the monetary ability to blink, but there's a debt trap. There is so much debt that you have to let essentially inflation go higher to wipe out some of the real value of that nominal long duration debt.
No, is it even deeper that actually central banks really thought they could fix anything? And so is there like an illusion of grandeur that is now biting us?
Yes, I think that a lot of the build-up of the debt that occurred in the last few decades is because central banks had too loose monetary and credit policies. Every time there was a bubble, they weren't fighting it and then picking up the mess afterwards. That led to a bias for excessive leverage. And right now we have so much debt, private and public, that the idea central banks can fight inflation is not credible. I think they'll have to blink, they'll have to wimp out, and we're going to have higher inflation expectations down the line.
We're just getting started with Nicola Roubini. I mean, there's one, but I don't think we have to pay for the bill, so we have to go to break. Globalization, page 153. Globalization as a concept stretches back to the earliest exchanges of goods between consumers at a village. We'll talk, of course, about globalization, the debt crisis, the bailout map. We'll talk about stagflation, which we mentioned, and the new Cold War. Nicola Roubini, Chairman and Chief Executive of Roubini Macro Associates, stays with us. We'll also talk, of course, about market valuation. In one word, are you happy you're in London?
I love London.
Is London better than New York?
It is. It is a nice place. I love Europe, and I grew up in Europe, so.
There you go. Roubini, long on the city of London. We'll discuss that next. This is Bloomberg. Good morning, everyone. Here are your top stories. Mixed signals. The yuan fluctuates. China accelerates the easing of COVID restrictions, returning the focus to growth. Trade data slumps. Sound the alarm. U.S. stocks slide as banks warn about the gloomy outlook. The Goldman Sachs chief executive says job cuts and smaller bonuses may be on the table. Plus, Big Pharma surges after a big win as a U.S. court dismisses cases against heartburn drug Zantac. GSK jumps the most in 25 years. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, still with us, Nicola Roubini, Chairman and Chief Executive of Roubini Macro Associates, with a great new book out, Mega Threats. Nicola, amongst those mega threats, and again, it's beautifully laid out. It's 10 mega threats, and what are the things that we can do and leaders can do to try and mitigate them. You have AI job destruction, you have the new Cold War, you have also the climate catastrophe. When you look at AI innovation and technology, can we harness it in a different way to actually help us with our goals?
Well, certainly AI, machine learning, robotic automation is going to increase the economic pie, even if the macro data do not show yet the increase in productivity. There's a bit of a paradox. The only trouble are two. One is that AI and machine learning is capital intensive, skill bias, and labor saving. So if you own the machines, the robots, or the capital owns those machines, you do well. If you're in the top 10% of distribution of skills, education, human capital, probably the AI makes you productive, more productive. But if you are a low value added, blue collar, but increasingly also white collar worker, or even middle value added, your jobs and your income is going to be gradually displaced by technology. Initially routine jobs, then cognitive jobs. Now with this chat GPT, even creative jobs.
But we've been talking about this for 10 years. So why did we not fix it earlier? This is, again, it's a jobs mismatch, it's a skills mismatch that could have been fixed with the right training, but also over a timeline that is longer than we have now.
Well, in many parts of the world, starting with the US, we have not really invested into skills very much. The level of education is mediocre, especially in STEM compared to other parts of the world. But in the past, there was a skill premium that comes from education. The trouble with AI is that even that educational skill premium may disappear because even jobs that are not just mechanic routine, but also cognitive or creative may be eventually displaced by technology. So education used to be the solution. It might not be as much in the future.
Nicola, who's getting it right? So we also have, big stories today on China, easing some of the curbs on, on restrictions so that they can travel more freely. So it feels like they're abandoning COVID zero policy. Does China actually really benefit from some of, if not the innovation, some of, the focus on AI? I mean, because of the large number of people, they just have better AI than us.
Well, they have no privacy, they have more data and so on. The trouble with China is that there are aging of population is becoming more and more state capitalism rather than private sector driven. And the technology of the future require knowledge, innovation that require freedoms they don't have. And it's also politically becoming much more authoritarian, on foreign policy becoming more aggressive. And you have a huge amount of debt, private and public. You have a real estate sector is going to crash and so on. So China is going to be at best 2-3% growth in the next few years, I would say.
So it doesn't really help the world economy like we thought it could 2-3 years ago?
No, certainly in the past when China was growing 10% was a major driver of rise in growth in emerging markets, even export by Europe to China. Today I would say China is going to be stuck into a middle income trap and is going to probably avoid a hard landing, but it's going to be very mediocre economic growth going ahead.
Okay, if you look at recession fears in the US, and I think you absolutely don't think we could avoid a hard landing. I mean, one of the indicators that we watch is, of course, the inversion of the yield curve between the 10 and 2 year. Is this a good indicator? I mean, we haven't seen it so inverted since the 1980s.
Usually it's a good indicator, but sometimes, of course, there are false alarms. It's not always the case that when it's inverted, you're going to get a recession. But I think that the most important thing is that in the last 60 years, there's never been a case in US history that you have inflation above 5%, right now 7.7, unemployment below 5%, now 3.7, that when the Fed starts to raise interest rates, you get a soft landing. You get, in every case, a hard landing. Even when you have cases of overheating from aggregate demand, let alone when you have like the 70s situation with negative supply shocks that reduce growth, increasing inflation, and when you raise interest rates, then you end up into a hard landing.
I mean, what would need to happen for us to see a kind of freeze of capital markets? Like 08?
Well, we're already seeing a significant rise in long bond yields. Credit spreads, high yield and grade are much higher. In the leveraged loan market and CLO markets, things are almost shutting down, not yet, but the spread have widened so much that the issuance has become much lower. So all the kind of excesses that occurred not in the banking system, but in the shadow banking system, that was private debt, CLOs, leveraged loans, fallen angels, high yield, those things are markets that slowly are becoming more distressed over time. And as we enter in a recession, the spread widening is going to be much more significant.
And we're seeing stress points, right? We saw something yesterday on currency derivatives. We're seeing, places in bonds. Where do you see it first? Is there something that you think could blow up before the end of the year?
I think that the stresses are going to come in the credit markets. If we're going to enter a recession, lots of institutions like corporates, households, businesses that are highly leveraged, I call them zombies, that are effectively insolvent, that were bailed out during the GFC, during the COVID crisis with zero rates, negative rates, CE, and quantitative easing, that will have significant increases in debt servicing ratio. So you're going to see distress in credit markets.
But no, these are probably not companies. I mean, is it companies that without taking a judgment, that actually, shouldn't have stayed alive so long in the first place?
I mean, the Fed...
Or is it healthy companies?
No, they were not. I mean, before the COVID crisis, the Fed was writing financial stability reports saying that their worry was about the corporate sector. High debt, trillions of dollars, leveraged loans, CLOs, high yield, fallen angels. And what happened during the COVID crisis that those institutions, those corporations, not only didn't go bust, but they were bailed out. Went to zero rates. We even bought high yield bonds. And therefore, everything was bailed out, and they borrowed even more. Today, unfortunately, with the rise in inflation, the Fed is rising rates from 0 to 4. They're going to go at least until 5.25, possibly, in my view, closer to 6%. Then the institutions that are insolvent are going to have to go into distress. And that's the credit stress.
And so that credit stress, what does that mean in terms of correction for the markets, for example, for equity markets? How much lower should we be?
Well, even if you had a short and shallow recession, typically from peak to trough, the S&P 500 falls by 30%. During the GFC, it fell by 50%. So even if we had a mild recession, right now the market is down, depending on the day, 15% from the peak, you'll have another 15% leg down. If we have something more severe than a short and shallow recession, but not as severe as GFC, you have to go to minus 40 from minus 15. So you have another 25% downside potentially in the markets.
What are you seeing in London? Do you really think, I mean, you just said before the break that you love London because it's a beautiful city.
No, I love London, but...
Financially, what will it become?
Well, let's put it this way. First of all, the UK is already in a severe stagflation, a double-digit inflation, and even the Bank of England is expecting at least 5 consecutive quarters of negative economic growth. Secondly, it's worse than the Eurozone because there was a self-inflicted wound. There was Brexit that reduced the supply of labor, restricted trade in a number of ways, weakens the role of city as a major global financial center, reduces potential growth, and increases cost of production. So the fact that the UK, relatively speaking, is doing even worse than the Eurozone or Europe or the United States is definitely a Brexit phenomenon.
Can they put regulation in place or incentives in place without spending too much, like we saw in the last couple of months, to reverse some of the negative effects that it's had on the economy?
Well, there is this talk about becoming like Singapore, reducing regulation, reducing taxes, reducing government spending. First, the comparison is wrong because Singapore is a high tax, high spending, high regulation country. The comparison should be with not Singapore, but with Hong Kong. But you don't want to compare it with the Hong Kong of today. Secondly, I think the idea that you're going to cut regulations is totally far-fetched. If you want to have access, even with a free trade area, let alone a customs union to the European market, you need to maintain the same regulation. And the idea that you're going to cut massively government spending to reduce taxes is also far-fetched. Yeah. It's not going to happen. If anything, they have to raise taxes right now, given the amount of government spending.
So what would you do?
I would say that right now, unfortunately, the United Kingdom is stuck in a low-growth situation. What you want to avoid is a loose fiscal policy going to lead to the type of stresses that occurred with the pension funds, and that's a risk. Okay. Literally, for a month or so, the UK was being priced like an emerging markets, with fiscal stimulus leading to a weaker currency and much higher interest rates. It's a severe risk that actually will have financial instability and distress in the case of the United Kingdom.
Nouriel, you also in the book talk about this new Cold War. I mean, it's incredible to think what we've lived to, frankly, in 2022. It's like a whole decade, and some of the concerns was distilled in the last 12 months, including the war in Ukraine. Will Europe stand together as the winter gets colder?
Europe will stand together, and NATO is now becoming stronger with the Swedish and the Finland joining in. But we live in this geopolitical depression. There are four powers, China, Russia, Iran, North Korea, possibly also Pakistan, that don't accept the economic, financial, political, and geopolitical order that the US, the West, and Europe created after World War II. And this geopolitical depression is going to lead to decoupling, to fragmentation of the global economy, balkanization of global supply chains, secure trade rather than free trade, feng-shoring rather than offshoring, and all those things are going to reduce potential growth and increase cost of production. They're also stagflationary. This process of deglobalization, of protectionism, and of decoupling.
This is my favorite party trick, trying to get to find some glimmer of hope in all of your predictions. Nouriel, I mean, could you see a situation where actually things, so Europe holds together, but also it kind of brings more innovation to Europe? Is there anything that you've been surprised on the upside?
Well, you know, in the race about the indices of the future that are based on AI, machine learning, IoT, big data, 5G, 6G, there's a lot of good, maybe academic or theoretical work done by Europe. But if you're looking at the application, is mostly the United States and China. Now, there are lots of European plans about building AI and you name it, but I think that realistically, Europe is falling behind, and that's a certainly risk to the potential growth of the Eurozone. These days, a game between US and China, I would say, on the industries of the future.
Nouriel, thank you so much. It's a real pleasure. I'm glad we finally made it happen in London, so you have to come back soon. It's a fantastic book. Look at this, a little bit of QVC action for me. Mega Threats by Nouriel Roubini.
Thanks for having me.
Of course, the chairman and chief executive of Roubini Macro Associates. Now, coming up a little bit later in the program, London no longer home to Europe's biggest stock market, with Paris now taking the crown. We speak to the Euronext chief executive, Stéphane Boujnah. That's coming up later, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, a few weeks ago, London was overtaken as Europe's biggest stock market. The crisis and confidence in the UK assets ran so deep that the country narrowly lost the crown to its nearest challenger, Paris. Brexit, a weak pound, and political upheaval have all been blamed for London's decline in this corner of the financial services sector. Now, we're now joined by Euronext chief executive. He is Stéphane Boujnah. Thank you so much for joining us, Mr. Boujnah, from our Paris office. Now, first of all, when you look at the potential for Euronext and, frankly, all of the industry in 2023, are you worried about what's coming, or how many opportunities do you see laying ahead?
No, we are extremely positive about 2023. We are observing an increased appetite of corporates for considering going back to the IPO markets. Clearly, the changes in the environment in the debt markets are re-rating the importance of equity markets. Clearly, more and more companies are rebuilding their balance sheet strength and reconsidering own funds and equity as a fundamental part of the financing of their growth. And 2022 was good in terms of IPOs. That was less good than 21, which was a record year. But 22 was a year which was consistent with the level of 19 and 20.
Do you think Paris is now a more attractive place to have an IPO after Brexit?
Well, Paris is a city where many companies are listed, but Paris is relevant only to the extent that it is one of the 7 gateways to the Euronext single market. There have been a lot of buzz and interesting comments about Paris aggregate market capitalizations being bigger than the London aggregate market capitalizations. But to a certain extent, it is irrelevant, because what really matters is not where companies are listed, but where companies are traded, in which market. And in this respect, the relevant metric is the fact that Euronext has built a single liquidity pool, a single order book, a single technology platform with an aggregate market capitalization of approximately 6 trillion euro, which is twice the size of the London market, and with about 12 to 13 billion euro of average daily volumes, which is twice the size of London. So what I want to highlight is that what is really impressive and really important is the integrated, consolidated market that exists across Europe and that we have built over the past 6 years.
I love that. That was like a lesson in diplomacy, Stéphane. You basically says, yes, you say France is a better place, but you didn't say it in as many words. London, as you say, is where a lot of, or most money changes hand each day. Do you think this could actually change?
Brexit was a big decision, and big decision entails big consequences. London used to be the largest financial center of the European Union, and everybody liked it. Today, London is the largest financial center of the United Kingdom, with global ambitions that are in the making and to deliver to a certain extent. So we are in an evolving situation, but clearly what is happening is that companies that under other circumstances would have considered being listed in London are listed outside of London. Ryanair left London to be listed at Euronext Dublin. Universal Music Group, a US company, decided to list at Euronext Amsterdam, and they could have been listed in London under previous circumstances. Allfunds, which is a Spanish company with significant operations in London, decided to list at Euronext Amsterdam, etc. This is the new normal. So I'm absolutely sure that the UK will continue to have an history consistent with its geography, and the geography of the UK is Europe, and the history of the UK is Europe. But as far as financial markets are concerned, clearly something fundamental has happened and is creating the consequences we are seeing today.
I mean, has your Euronext business also benefited from the equity market volatility this year? Yeah,
clearly, because we have built in parallel to Brexit, which started in 2016, because we have seen in parallel to that the building of a very large integrated market, when 25% of the shares traded in Europe are not traded in Euronext markets. We are internalizing more and more of the flows, and clearly the volatility is creating an opportunity for all markets because they are integrated in something which is now very large and very relevant for listing, for trading, and for post-trade.
When you look at M&A, where do you see opportunities to build up businesses? Is there something that you think Euronext could be much better at by acquiring something?
Yes, external growth is a fundamental part of our strategy. I mean, clearly the growth of Euronext over the past 6 years has been the consolidation of European markets, with the acquisition of the Irish Stock Exchange in 2018, the acquisition of Oslo Børs in 19, Borsa Italiana in 21. So if and when opportunities arise, we will continue to look at opportunities to expand our footprint and to connect better European local economies with global markets. That is our purpose, and that is what we have tried to do over the past 6 years, and that we are going to continue delivering.
Okay, Stéphane, thank you so much. Stéphane Bourgenader, the Chief Executive Officer of Euronext. And of course, the conversation with Stéphane also continues on the podcast. That's out tomorrow. We'll talk about clearinghouses and, of course, other things that we'll expand on, including some of deregulation, Big Bang 2.0 here in London. Now, coming up, we'll get a roundup of your top stories, including Big Pharma, GSK and Sanofi surging after a U.S. court win around a heartburn drug. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned that Morgan Stanley is to reduce its workforce by about 1,600, some 2% of total staff, as Wall Street prepares for a potential U.S. recession. Meanwhile, speaking to Bloomberg, the Goldman Sachs CEO, David Solomon, struck a downbeat note about the economic outlook and said potential job cuts should come as no surprise.
We're at a very uncertain time, given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact of slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead. We could see a recession in 2023 also. And so I think you've got to be cautious and prepare.
Now, it is reported that privacy regulators at the EU will rule that Facebook owner Meta shouldn't require users to agree to personalized ads based on their online activity. Such a ruling would limit the data the company can access to sell targeted adverts. Meta shares have fallen by about 2/3 this year. GSK and Sanofi shares have risen sharply after a US federal judge rejected the scientific evidence behind more than 5,000 lawsuits claiming the heartburn drug Zantac can cause cancer. UK-based GSK welcomed the ruling and says it will continue to defend itself vigorously, including against all claims brought at the state level over in the US. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. This is a picture for some of the pharmaceutical companies out there. We're seeing a big boost for GSK, but also Sanofi. This is on the back of a judge in the U.S. actually saying that there's not a linkage between cancer and one of the acid reflux drugs that they're producing. GlaxoSmithKline, you can see, gaining 8.6%, Sanofi gaining 5.7%. The picture also for some of the other things we're watching out for, including Brent and actually, in general, commodities. This is a picture, I think, if we have that. There you go. NYMEX 73.23. Now, stocks in general slipping. We did have some China data actually compounding some of the fears over a recession. Now, recession fears definitely palpable in the bond market, where a yield inversion were hit by a 4-decade extreme, sending a 10-year rate below those 2-year notes by the most since the 1980s. We'll have plenty more, of course, on that throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York. Anna Edwards is here in London, and this is Bloomberg.
We're at a very uncertain time given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact of slowing down economic activity.
The reality is that consumers are starting to run out of dough.
I actually don't think that it's a foregone conclusion that we'll see a recession in any segment of the labor market. I do think we'll see a transition.
The likelihood of a soft landing is quite low. Yes, it's possible. Yes, there's a hopeful scenario where you can get a soft landing, and everybody would like to see that. but we need to be realistic.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Democrats get a big win. Senator Raphael Warnock defeats Republican Herschel Walker in the Georgia runoff. China makes a major shift from COVID zero. Beijing eases restrictions in an attempt to boost the economy and quell public discontent. And job cuts on the way at Morgan Stanley. Bloomberg's learned the bank will eliminate 1,600 positions. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And Kailey, we got some seemingly big news out of China in terms of the scale and the scope and the speed of lifting of some of those COVID measures, but not enough to capture the market's attention, it seemed.
Yeah, there was good news and then there was bad news, arguably, out of China overnight. Obviously, as you say, Anna, on the good side of the equation is that more rapid than expected, perhaps, easing of COVID-0-related restrictions. But on the other hand, you also had weaker economic data, both exports and imports in the month of November contracting more than expected. So really speaks to the struggle remaining in the Chinese economy. So that, coupled with maybe some concern about a spike in infections if restrictions are eased, took risk appetite much lower in Asia overnight. The MSCI Asia Pacific Index overall down about 1.4%, and the Hang Seng China Enterprise Index underperforming, down about 3.3%. Interesting, though, while Chinese equities were under pressure, the Chinese yuan has held in there mostly against the U.S. dollar. It's essentially unchanged, the offshore yuan to the dollar right now, trading at 6.98. But the big underperformer in Asia is the Japanese yen, weaker against the dollar by about 0.5% after a BOJ board member pushed back downplayed concerns about higher wage growth, pushing back on the idea that monetary policy needs to be adjusted. And as a result, the dollar trading at 137.59 to the yen. Matt.
All right, interesting to see that dollar movement. Although on my board, I've got the Bloomberg Dollar Index here in the second row, but the bottom of the board, I think, is the most interesting. An incredible drop in crude prices, and all the more interesting since we continue to talk about this kind of incremental reopening of China. We've been down to 72.75 on NYMEX crude today. That's the lowest level since 2021. So even as we talk about a reversal of the COVID zero policy, or at least a loosening of the COVID zero policy, we're still seeing a huge drop in crude. And I think that shows you how concerned this market is about a recession in 2023. We're going to talk about all the bank CEOs coming out with super negative, well, not super negative, but definitely bearish outlooks yesterday, and that's being reflected in the crude price right now, trading at $73 for NYMEX. Brent also down. S&P futures are off 0.2%, which doesn't seem all that bad until you look at the cash trade over the last couple of days. We've been down more than 1% over the past couple of days. So as we get positive economic data out of the U.S., like the jobs number on Friday, like the ISM services number on Monday, that just convinces the market that the Fed's going to have to raise rates more. That's going to hit the economy harder in 2023, and that's why they're selling off stocks. That's why they're selling off oil. We see the dollar index right now, very little change, but at 1271 from a high of 1350, and the 10-year yield at 352 from a high of 424, I think. So very interesting to watch this space, but really it's all about oil for me today, Anna.
Yeah, absolutely. All about oil. I've got Brent in my board as well. Let's start, though, with what's happening at the European stock market level. And to your point, Matt, it seems the narrative around weaker global growth, what the Fed does about that, that's all outweighing the potential upsides from China reopening in the market psyche this morning, because we see European equity markets moving weaker, down just 0.1% in London, but elsewhere down 0.4% on the DAX and on the CAC 40. We just got a confirmation, the final reading of third quarter GDP for the euro area. It came in at 0.3%. The initial reading was 0.2%, so slightly better than anticipated, very much at the margin. But of course, all the focus is really on just how quickly we do go into a recession, how deep it will get for the Eurozone economy and for more broadly the European economy. We'll talk about that in a moment with one of our guests. Here's Brent crude then, as Matt was pointing out, real weakness coming through in WTI despite the reopening narrative in China. We had the ingredients, if the market had wanted to send oil higher on the back of that. But 78.20 is where we are, down 1.5%. So a handle now on Brent below $80 $6 a barrel. Sticking with the commodities theme, this is the UK natural gas market, and I put this in here. This is up by just under 4% today because we are in for some cold weather over the next few days. We're in for some cold weather and some snow, apparently, and all of that at a time when wind turbines are not spilling all that effectively over the next few days, not expected to at least, and so that could push the price of gas up. We see a little bit of that today. GlaxoSmithKline and Sanofi, this is the same story. I could have put in Haleon as well. Haleon, which is the consumer unit that was spun out from GlaxoSmithKline just months ago. All of those stocks rallying really strongly. GSK was up around 14% earlier on today. This on the back of a ruling by a US court or a US judge deciding to throw out the scientific evidence that had been provided by plaintiffs in a case that was trying to prove a link between the heartburn medication Zantac and certain types of cancer. The judge has thrown out that scientific evidence, and so the manufacturers of that on-brand and also generic drug move higher today on the back of that news, Matt.
All right, very interesting stuff indeed. Let's get to the political angle this morning, because incumbent Democratic Senator Raphael Warnock has won a contentious re-election in Georgia. It was a runoff vote, of course. Warnock defeated Republican Herschel Walker with a little more than 51% of the vote. Joining us now from Washington is Zach Cohen, Bloomberg government Congress reporter. And Zach, we've been going over this over the past few days, but just to explain again why it's so important that the Democrats have 51 to 49 rather than a 50 to 50 split with the vice president helping them tip the balance.
Right. Over the last 2 years, Democrats have had a sort of nominal majority in the U.S. Senate, as you mentioned, because Vice President Kamala Harris is able to break ties on procedural questions or on final votes. That allows them to essentially overrule Republicans, even if technically it is split 50 Democrats, 50 Republicans. With Senator Warnock winning re-election over Republican Herschel Walker, that gives them an outright majority, not just on the floor, but in really key committees, and that should help them move along, nominees, bills, what have you, that typically only require a simple majority. Now, the filibuster is still a factor. Democrats still have to contend with a 60-vote threshold in order to advance most legislation. But certainly an outright majority, 51-49, is going to help Democrats accomplish their agenda much more easily than they were able to with a 50-50 split, with the caveat that, of course, Republicans narrowly flipped the U.S. House. And so there will need to be some bipartisan negotiation in this new era of divided Congress.
Right. It's going to be a divided government for 2023 and 2024. But as we look ahead to 2024, what does the fact that Georgia elected Warnock for a 6-year term mean for the presidential race? This was a solidly red state in the past.
Yeah, Republicans used to be able to count Georgia in their column regardless of the race, whether it was for president or Senate, governor, and the incumbent governor, Republican Brian Kemp, was able to easily win re-election, whereas Senator Raphael Warnock won re-election, and President Biden carried the state in 2020, albeit by a very narrow margin. And so 2024, it'll absolutely be another one of those really key competitive states that Biden or former President Donald Trump or whoever the nominees for the major parties will need to compete in. Warnock was able to win by carrying Atlanta and some of the suburbs, while the rest of the state really went for Walker. And so Atlanta really does seem to be a really key indicator here of where future races could go. But I can expect that, after millions of dollars spent just in the last 4 weeks on television advertising in the Georgia Senate race, that certainly voters there should expect to hear a lot more from both political parties in the lead up to 2024, when, again, it will be a key race for the presidency.
Zach, thanks very much for your time. Zach Cohen of Bloomberg Government joining us there from Washington with the latest on U.S. politics and that Georgia runoff. Now, China is moving away from its long-held COVID-0 approach, easing a range of restrictions, and some of these now national easing of rules. It comes as the country's exports and imports both contracted in November, external demand continued to weaken, and a COVID outbreak disrupted production and cut demand at home. For more, we're joined by Bloomberg TV's Tom McKenzie, who has a rundown of everything we need to know connected with the China story. Tom, what is the detail of these China COVID measures then easing? Because for a time we were talking about maybe more piecemeal measures in certain geographies, but this seems to be more broad-based.
It is, and it's more significant. So you're right, we've had the rumours, we've had the speculation, we've had some easing and then U-turns on the easing. Now, though, you have the Communist Party's Politburo, the powerful Politburo, coming out and saying that the pivot is there, crystallising, cementing that pivot away from COVID-0, saying that the time has now come, that China is able to move away from a policy they still claim as a success, particularly in terms of keeping the death rate lower and the infection rate lower. So we have measures including you no longer need to test to get into many public venues like shopping malls and restaurants. restaurants. You don't necessarily have to go and have forced quarantine in a government quarantine centre. You can now quarantine at home. And they've also eased some restrictions around travel as well. So this is consequential. This is today the moment when China has signalled it is pivoting away from this controversial COVID-0 strategy. The crack team, though, of analysts at Trivium, and I need to name check them because they're on the ground in China, they've said that walking out of exiting COVID-0 is going to be no cakewalk. It's going to be challenging, and maybe that's why investors are pausing for thought this morning.
And I could think of another potential reason why investors are pausing for thought, Tom, and that is that the data was relatively weak when it comes to November trade figures. Tell us more about that.
Yeah, so exports and imports both down between 9 and 10%. A drop of about 9% for exports for the month of November, imports down about 10%. And the context, Kailey, is this, that exports have been powering ahead in the last 2 years, a key pillar of strength for China's embattled economy. That strength is now crumbling. These are the weakest numbers we've seen since about early 2020. Now, the government, policymakers have said, look, they're going to react forcefully in terms of targeted but forceful measures on the fiscal front, monetary policy as well. But you're absolutely right. This weak data underscores why they need to wrestle themselves away from COVID-0. There's the weak external demand picture, and that's despite the fact that we're heading to the holiday season, and the domestic demand as well as those production constraints. So all of those three things coming together, a kind of whirlwind of challenges for the trade sector out of China. And again, underscoring why they need to act. And again, that additional monetary and fiscal policy response that we should expect in the weeks, months ahead, particularly as we're looking to 2023.
Tom, thanks very much. Tom McKenzie joining us there with the latest on the China story. Now, US bank CEOs are striking a cautious tone, yes, have been striking a cautious tone, at the Goldman Sachs US Financial Services Conference. Goldman CEO David Solomon warned of bumpy times ahead for the global economy.
We're at a very uncertain time. An uncertain time given we're changing monetary and economic conditions very, very quickly.
The economy is being slowed by the higher interest rates, by the fact that the inflation is eating up more of a person's savings.
I think you've got to be cautious and prepare.
If we head into a sustained recession, and I think we will go into a recession next year in the U.S.
We could see a recession in 2023 also.
If we have to make tough decisions, which I think we might, we will do that.
I just think it's going to be a rude awakening.
We have some bumpy times ahead.
Now, with Wall Street preparing for a potential US recession, Morgan Stanley is planning to cut its global workforce by about 2%, amounting to roughly 1,600 employees. Bloomberg's Kriti Gupta joins us now with more detail. Kriti, take us through the sort of negativity we're hearing from Wall Street executives, how significant a move that is, and how that translates into job cuts.
Well, it's a real pivot, not to use a Fed term here, but it's a real pivot from what these Wall Street CEOs have been saying for a while. Think Jamie Dimon, think Brian Moynihan of JPMorgan and Bank of America, respectively. They've both been massive advocates, very vocal advocates for the American consumer. They're saying, look, the data is not that great, but the consumer is going to keep spending, and they have been right until now. The game changer here is what David Solomon said. Remember, he's been a skeptic on the U.S. economy for some time now. So to actually see him be out in front of this and start to say, okay, well, not only are we going to have a recession that's starting to seep into the base case, now we can actually zero in on timing and really say it's going to happen in 2023.
All right, so a lot of bad sentiment coming out of Wall Street CEOs yesterday. We also had news on Credit Suisse that it's trying to reel back in some of the $90 billion in outflows it lost from wealthy clients. They're offering as much as 7% in low-risk rates.
They are, and it's all at its core a liquidity story. Of course, there's those solvency rumors back in October. They've lost about 10% of their business. And the way to recoup some of those funds, well, they're doing it in pretty dramatic ways. Get this, some deposits of 5 to 6% return or interest rates, that's what they're offering here, or even some fixed rate notes of as much as 7% to some of their clients. And on the flip side, they're actually pausing some of their loans. They're not lending as much as they are, really trying to bring back as many of those depleted funds as they can.
All right, Bloomberg's Kriti Gupta, thank you so much. And now with a look at some other company stories we are following and looking at the moves in free market trading here in the U.S., we have to talk about marijuana and pot stocks because the Safe Banking Act, which would make it easier for legal operating cannabis businesses to bank in the United States, is not going to make it in that must-pass defense spending bill. Remember, yesterday we heard the Senate Minority Leader Mitch McConnell talking about criticizing Democrats for trying to force that to be included in that bill. It will not be. So after falling between 13 and 16% in yesterday's trade, we are seeing losses continuing for some of those stocks, including Tilray and Canopy. They're down about 3% and 1.7% respectively. It is also a decline for another stock, Airbnb, getting downgraded at Morgan Stanley. The analyst pointing to slower listings growth as well as weakness in demand for night bookings. So as a result, Airbnb is down about 3%, but a much more positive story for MongoDB. This is a database software company absolutely soaring in pre-market trading after a beat and raise quarter. Analysts pointing out how rare that is in a weak macro environment, but this company clearly doing well. The stock getting rewarded up 27% before the bell, Anna.
Fascinating name. Kailey, coming up on the program, we will turn to the macro stories dominating the conversation as we head towards the end of the year. Nicola Mai joins us, PIMCO portfolio manager and sovereign credit analyst. What opportunities in fixed income right now? And we'll also talk politics. Terry Haines joins us, Pangaea Policy Founder. A lot to talk about in the wake of that Georgia runoff, but also the broader picture heading into next year. Plus, the world's richest family is getting richer. Today's Big Take story takes a look inside the secretive Gulf family and their $3 billion fortune. Look for that online or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both TV and radio. If you're listening this morning on Bloomberg Radio, I will walk you through a chart that, to me, is pretty shocking. Oil has completely erased its 2022 gains. In fact, at the low this morning, we're looking at a price that we haven't seen since December 21st of 2021. And that in the face of a reopening of sorts in China, at least backing off from the COVID zero policy you would expect. That means demand is going to pick up big time. So why are we seeing this commodity so linked to global growth drop in price? Joining us to talk about this and more is Nora Melinda, Bloomberg Equities reporter. Nora, it does seem like people are much more worried about a recession now in 2023 than they are optimistic about the potential for China to contribute to global growth.
Yes, there's definitely a lot of uncertainty in the market right now. Of course, we've seen more distress. And specifically yesterday, we heard from a lot of major banks, from Jamie Dimon saying that this could be a mild to hard recession, to Lisa Shallop
That's a broad, mild to hard?
Mild to hard, right.
But a recession,
it could be nothing and it could be everything.
A recession is the operative word there, Matt.
Definitely. But, I'm really interested to hear from asset managers and retailers because, of course, we know that these major banks are hurt right now. They're doing a lot of, $1,000 cuts to bonuses. So I think that it'll be interesting to hear the perspective of people who are also directly involved with these investors on a day-to-day basis and see what they think. I think there's a lot of mixed sentiment right now.
Well, we know that for 4 days in a row, investors have been selling U.S. equities, quite a losing streak for the S&P 500. When you look at the different data coming out of places like Bank of America when it comes to flows, what does it suggest about where people are putting their money right now and where they're pulling their money from?
Yes. So Bank of America, we've been looking at the client flows, really interesting. So institutions are actually buying right now. Retailers are selling. And, institutions, we think of them as smart money. They're actually pouring their money right now into growth stocks, some of the most beaten down stocks this year. So I think that that's really interesting to look at. And also Bank of America has mentioned that the next 2 months tend to be the strongest when it comes to equity inflows, January being the strongest in particular. So I think we'll just have to wait and see what moves in the market ahead.
Yes, and some of those moves in the market, good morning to you, Nora, could be dictated by next week's data. We get quite a lot of data, not to mention some meetings as well.
Yes, next week will be a very, very busy week. Of course, we've got the Fed meeting, and right before that, we're going to get CPI data, which will be a really important print, just to see whether or not inflation will remain sticky or if it's calmed at all. So, of course, all eyes across the market are looking toward that meeting and seeing whether or not any of this data will impact what the Fed decides to do moving forward.
Yeah, feels like we've got one more week maybe until
almost
the end of the year. Nora, thank you very much.
Almost there.
Bloomberg's Nora Melinda helping us get towards the end of the year. And for more market analysis, check out MLIV Go, the function on your Bloomberg takes you to the Markets Live blog, where they will also help you get to the end of the year. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. Secretary of State Antony Blinken says the U.S. had no role in Ukrainian strikes inside Russia. The Kremlin has accused Ukraine of carrying out drone attacks that were the deepest inside Russian territory since the war started. Ukraine has not claimed responsibility. Two of Donald Trump's companies have been convicted in a criminal tax fraud trial in New York. They were found guilty of engaging in a scheme that allowed executives to evade taxes on company-paid perks for more than a decade. The former president was not charged, but prosecutors told the jury he knew exactly what was going on. And President Biden celebrated TSMC's plans to increase its investment in Arizona to $40 billion and build a second chipmaking factory. The president toured the Taiwanese company's facility in Phoenix. Companies such as Apple are eager to buy more chips made in the U.S. and, of course, Anna, reduce their dependence on China.
Yeah, absolutely. That got a lot of coverage, didn't it? That visit yesterday, just how significant it is. Really interesting analysis by our opinion team over in Taiwan to dig that out on the Bloomberg terminal. Coming up on the program, Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. What does he make of the pivot into bonds that we're hearing a lot about from some managers? This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Democrats get a big win. Senator Raphael Warnock defeats Republican Herschel Walker in the Georgia runoff. China makes a major shift from COVID-0. Beijing eases restrictions in an attempt to boost the economy and quell public discontent. And job cuts on the way at Morgan Stanley. Bloomberg's learned the bank will eliminate 1,600 positions. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, European equity markets, US futures, all weighed down perhaps by, well, some of the same themes of yesterday. Fears about the extent to which we'll see recession in the United States next year.
That's right. It seems as though all the bank CEOs that we spoke to, that Sonali Basak talked to at the Goldman Sachs conference, were so pessimistic that the market is now concerned about a recession, more concerned than it was the day before. We saw a big drop in the cash trade over the last couple of sessions, and now futures are down about 0.3%. We have investors buying 10-year debt right now, pushing the Treasury down to 352.94. This coming off a high just over a month ago of 424. So yields have really come in here. And NYMEX crude is off 1%. I think this is the most striking move. We have been down under $73 in this session. And this as we see China reopening or reducing its COVID-0 policy, backing off of that. You'd expect the demand out of that massive country to drive the price of crude up. On the other hand, recession fears seem to be weighing on the price, pushing it downward. And then I put in gold, which I think is really interesting because of a Zoltan Pozsar note yesterday, the strategist saying that there's an outside possibility after the European price cap, or a Western price cap, I should say, on Russian oil, that Vladimir Putin instead demands gold for crude, and that pushes up the price of the shiny stuff and weighs on the dominance of the dollar. Now, I think a lot of people feel that's a very outside possibility, but it's still interesting to think about, and as a result, we're looking at gold right now, $17.72 a troy ounce. Kailey, what do you see in terms of the U.S. markets? The pre-market movers.
Well, it's interesting. You were talking about the China story, Matt, and how, in theory, the dramatic almost reopening and easing of restrictions in that economy when it relates to COVID-0 should give a boost to Chinese stocks, maybe, but that was not the case overnight, and it's not the case for those ADRs here in pre-market trading this morning. The likes of Alibaba and JD.com actually down pretty substantially to the tune of about 5 to 6% each. But remember, these stocks absolutely ripped in the month of November in anticipation of a relaxing of some of those curbs. So perhaps all of that good news was priced in already. Maybe that's what's going on here. I would note as well that it isn't just Chinese technology stocks and their U.S. listings under pressure. It is U.S. technology stocks as well. Tesla down 2.3% and Apple also down about 0.9%. So big tech obviously dragging on the broader market this morning, Anna.
Yeah, and Kailey, it's the China story also failing to lift sentiment here in Europe as well. We're down by 0.7% on the Stocks Europe 600. So the longer we spend trading here in Europe, and we're now 2.5 hours into our trading day, the worse things seem to get. So moving a little lower this morning. Brent crude also not getting a boost, to Matt's point, from that China story. 78.42 is now the handle, 78 the handle on Brent. So despite the reopening narrative, despite the fact that we get day after day further moves from the Chinese authorities, and these latest ones seem quite substantial and to be quite national as opposed to very regional. That's not having an impact in today's market, at least. We'll see what happens from here. This is the natural gas price here in Europe, heading a little bit higher. We've received some forecasts that suggest that the next few days could see some really cold weather in the UK and snow and all of that. And that at a time when the wind turbines are not really going to be spinning as many people would have hoped. So that could push gas prices higher, and that we're seeing a little bit today. GlaxoSmithKline, GSK, up by just shy of 9%. I could have put in here, and I did last hour, Sanofi. Could also have talked about Haleon, Matt, which was the consumer arm spun off from GlaxoSmithKline recently. The reason these stocks are rising is the same reason that they fell, or the opposite of why they fell in August by a substantial amount. And that's because in August we saw a legal case brought against them, which the scientific arguments behind have now been thrown out by a judge in the United States. It was all to do with whether Zantac produced cancer, and the judge says that the scientific arguments are flawed, and so has thrown out this case. So that's why we're seeing this sort of relief rally, if you like, in the producers of the branded and the unbranded generic versions.
All right, very interesting stuff, and we're going to continue to follow those movers. Right now, though, I want to talk about the broader market with Nicola Mai, PIMCO portfolio manager and sovereign credit analyst. First off, Nicola, I want to get your take on the pessimism that erupted yesterday out of Wall Street CEOs. You can see it in the drop in equities over the past couple of sessions, and really in the drop in the price of a barrel of oil. Why do you think, as we continue to report these incremental changes in terms of China reversing its COVID-0 policy, that we have crude dropping to a level we haven't seen since 2021?
Well, I'm afraid I kind of agree with the pessimism that was shared by some of the colleagues in the market. Our expectation is for recession in the coming quarters in Europe, but also in the US. And I think, the purchasing power squeeze on households from higher inflation, the significant tightening in financial conditions, record low sentiment, I think, mean that contractions in activity are very likely in coming quarters. I mean, you're right that the Chinese news on balance have been positive, the relaxation of property regulations, as well as the prospect of a reopening from the COVID restrictions. But I would just remind that a proper reopening is unlikely to happen until the second quarter of next year. I think it's going to be a gradual process. Cases are high. There's still a tendency to keep restrictions pretty strict. So it will be a lift, and eventually in 2023, China could even outperform expectations. But I think in the near term, the prospects are not that good. So if you look at oil prices, I think they're reflecting that in a way.
They're reflecting that, yes. And we talked to a number of economists. I know we did a survey at Bloomberg that suggested the timing you quote there, Nicola, is quite a sort of common assumption around the second quarter of next year for further real reopening. So if we are heading towards a recession in the broader economy, the global economy, certainly in the US anyway, it seems to be the thinking of yesterday, do you like bonds? Do you like the bond markets? And which parts of the bond market if we're preparing for recession?
Yeah, I mean, I think bonds offer a pretty compelling investment right now. I mean, you can take 2-year duration risk in the US and get a yield of 4.35%, which is something you couldn't have dreamed of, a few years ago. I think yields are higher across maturities. Obviously, as you go into recession, you want to stay in quality. So first of all, I think that the rate peaks priced in the market for central banks are broadly appropriate in terms of being enough to bring inflation down over time. So that means that government bonds are pretty attractive at these levels. And if you look in the corporate space, obviously you need to be careful because, as I said, we're entering recession, so you want to stay away from default remote names. And our bias is to stay in the higher quality spectrum. And there you can get some high quality default remote bonds for 6-7% yields, which honestly are quite attractive, especially in an environment in which equities continue to look quite expensive relative to the macro outlook.
Well, Nicola, so much of the narrative coming into this cycle was that not only was the consumer healthy, but corporate balance sheets were very healthy as well. So that default risk seemed like it was relatively lower than it has been in cycles past. Why not be willing to take more risk on that front then?
No, I mean, I think you're right that there is already a decent amount of defaults priced in the credit markets. And after all, we do expect a recession, but a relatively mild one because of the lack of imbalances that you mentioned, both in the household and in the corporate sector. You know, having said that, when you enter a recession, you know, the vulnerabilities do show up. The fragile companies are the ones that are going to be hit the most. So you want to be selective. And I think especially as you enter a recession with some uncertainty on the depth of recession, I think you're better off staying in the higher quality space where, as I said, you already get pretty attractive yields. Having said that, if you do your bottom-up work, there will be some high-yield names where it's worth investing, but I wouldn't more broadly focus on the lower quality at this point.
How much risk, Nicola, do you attribute to the Fed doing too much, hiking too much? I spoke to a guest earlier on who was saying that he'd been looking at the rate at which M2 was pulling back to the money supply and suggesting that this did look quite unusual and that there is really a risk that the Fed goes too far here. How would you assess that risk?
Yeah, I think the Fed has a really difficult job because monetary policy, you can only see the effects of monetary policy with a lag. I think Larry Summers had a great quote where he said, you know, moving interest rates is like turning the tap in the shower of an old hotel. You only know if the water is too hot after a while. And I think that's the situation the Fed is in right now. You know, I think broadly speaking, the tightening in financial conditions we've seen looks broadly appropriate, and it makes sense for central banks, including the Fed, to slow the pace of tightening at this point and witness the effects of the tightening. I would say that you know, it's possible the Fed will have to go a little bit beyond market pricing from here, but I would say not a lot beyond that, given what we're seeing in activity in the interest rate sensitive parts of the economy and in the financial markets. You know, I think we're pretty close to what will likely be the peak in terms of policy rates, in terms of what's priced in the market.
Okay, Nicola, thank you very much for your time. Nicola Mai of PIMCO, thanks for coming to talk to us. Coming up on the programme, we will have more on the Georgia runoff. Terry Haines joins us, Pangaea Policy Founder. We'll look at policymaking in the year ahead stateside. This is Bloomberg.
Is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with former U.S. Trade Representative Susan Schwab. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Well, on the subject of U.S. domestic politics, the Democrats have narrowly retained Georgia's Senate seat, giving them an outright majority in the U.S. upper house. Senator Raphael Warnock defeated Republican challenger Herschel Walker in the state's hotly contested and expensive runoff election. Joining us now for more is Terry Haines, Pangaea Policy Founder, who is up early for us here on the East Coast. Terry, thank you so much for joining us. 51 seats in the Senate, so maybe an individual like Joe Manchin has a little bit less power, but what difference realistically is this going to make?
Good morning, Kailey. Realistically, I think it means almost no difference, frankly. Democrats had effectively 51 seats before by using the vice president's tiebreaker. So now you get a clear 51. There's a lot of crowing that this means different results on committees and the like. What you got to remember about the Senate is that, you know, it's not really as much an organized political body as it is 100 CEOs, all of whom have to be accommodated, or at least 60 have to be accommodated on the Senate floor in order to get anything done. So that's not going to change a whole lot, whether it's 51 or 50, frankly.
Does this, though, limit the ability of someone like Joe Manchin to stop the Democrats' legislation agenda?
No, I don't think it does, Matt. And the reason why is that it's not just Manchin and it's not just Sinema. You've got, you know, I'd say a half a dozen members, others who are not inclined to be as public as Manchin or Sinema. They don't want to take the political heat at home or nationally for a lot of things, but yet they'll step up on a variety of things. I think it's always a mistake to think that Manchin's representing only himself or that Senator Sinema is. What you're going to find is that it's very, very difficult still to put together 51 votes for anything on final passage, but more importantly, 60 votes on pretty much anything on the floor. So, net, what you still have is you've still got a Senate that's very, very difficult for Senator Schumer to even control his own side. And of course, you've got divided government. So that means negotiating with a nominally Republican House that's got its own problems on trying to keep its side together. So what calculus does this then change, Terry? I mean, with 50 already, the Democrats could stop a conviction of a Biden impeachment. Why does it matter if they have 51? It doesn't so much. It's good political hype to talk about having absolute majorities. It's a good way to talk about your achievements and having a good and unexpected midterm result if you're a Democrat. But net, this really doesn't change a whole lot. You've still got to cobble together votes. You've still got to come up with policies. And I'd say the net effect is that for the current situation in Washington overall is that it makes centrists' job easier on some things, but it makes companies and interest groups tasks harder on other things. Let me give you a quick example. On financial services, for example, where you've already seen centrists push back against Biden progressive nominees in places like the Federal Reserve, bank regulators like the comptroller and the like, and defeat those sorts of nominations. So that's a triumph for centrists. But on the other hand, it's going to be that much more difficult for the financial services industry, say, or tech industry to try to use Congress as leverage against regulators because there frankly won't be consensus one way or the other on those things.
On the international front, Terry, does it look like harmony? Does that look like parties will be on the same page on all the important international policies ahead?
Well, I'm glad you bring that up, Anna, because my view of the next Congress, very simply, is continued domestic gridlock, continued fiscal harmony, grudging harmony on the things that basic things that matter on government funding, but unanimity on international. What you're going to see, whether it's Democrat or Republican, is you're going to see the continuation of great consensus on issues like Russia, Ukraine, and China. And I think those are all very good. Certainly for those who care about the United States position, that's very good news.
Terry, just quickly, as we look ahead to 2024 and a man who has already declared his candidacy for that presidential race, former President Trump, he obviously backed Herschel Walker. He backed many candidates in the midterm elections that did not win their races. Is this about the former president backing candidates that are flawed, or candidates being backed by a flawed former president who is losing his grip on the Republican Party?
Yeah, I'd say the second, your second is very well stated. I wrote a couple of weeks ago that I thought that former President Trump had jumped the shark in political terms. And that's both because of electoral performance. This is someone who's now seen as a serial loser, between 2020, 2021, 22 midterms, and now Georgia. And these increasingly outlandish statements about suspending the Constitution, as well as his very ill-timed presidential bid announcement coming after the midterms. So, my view of the Republican Party is they've been looking to try to figure out how to get past Trump for some time, and that's been ongoing. But that work accelerated greatly after the midterms, and I expect that to continue. I do not expect President Trump to be the nominee of this party in 2024.
Terry, thanks very much. Thanks for your analysis. Terry Haines of Pangaea Policy bringing us an update on U.S. politics. Coming up, Francisco Blanche of Bank of America Global Research joins Bloomberg Surveillance to talk oil demand as China begins to ease its COVID rules, not having an upward input onto the oil price, though, today. 78.70 is where we trade on Brent, down 0.8%. Analysis later. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now let's get to Credit Suisse. The story of the day is that the wealth management unit is trying to claw back some of those $90 billion in assets that have been lost by offering higher interest rate products and higher yield notes. For more, Bloomberg's Marion Halftermeyer joins us out of Zurich. So, Marion, I was excited to read this story. It looks like they're offering like a 7% CD, which is a huge rate.
It's pretty interesting. It definitely is. You definitely see some of the efforts that they're trying to make to bring clients back to the bank. You know, some of these products aren't necessarily unheard of. Many wealth managers use these types of incentives to bring client assets in before the end of the year to show, you know, good AUM for the year. But yeah, it's an interesting interest rate, certainly. I'm not sure it will convince clients to bring back the 80 to 90 billion that they've taken out.
Right, yes. I was going to ask you, Marion, how successful is this push expected to be then?
Look, I think you have to take it into the broader context. The bank is obviously still having to prove itself. The restructuring plan has just started. They're going to be really making a lot of the moves that they've announced in the next year. So it's still not clear, you know, exactly how the bank will progress. And I think that for a lot of clients, that's going to be keys, seeing, you know, what the bank looks like next year. So I don't necessarily think that they're going to be bringing all that back before the end of the year. And, you know, executives and people we've spoken to have said as much. You know, they know it's a long haul that will continue over the next couple of quarters.
Marion, who realistically is going to be left to bank for these people, assuming they do come back to Credit Suisse?
From a talent perspective, it's a question. I mean, that is top of mind for a lot of the relationship managers and the private bankers. You know, they are worried about whether or not they will even be at the bank next year to service the clients that they're trying to get to come back to the bank. So it's a bit of a weird conundrum. But that being said, you know, the executives have said that most of the job cuts that they plan to be making, and that's 9,000 tops for the next 2 years, will come more from an operational side of things, from IT, ops, those types of people, rather than really the front-end business.
All right, Bloomberg's Marion Halftermeyer in Zurich, thank you so much for joining us. Now let's take a quick final look at what is coming up for the rest of today as we wrap up Early Edition. At 7 a.m. Eastern, we will get U.S. MBA mortgage applications. Then at 9:30 a.m., ECB Executive Board member Panetta will be giving a speech at the London Business School. The ECB, of course, holding a meeting next week along with the Federal Reserve. Plus more central bank action later. At 10 a.m. Eastern, we get a rate decision from the Bank of Canada, followed by Brazil at 4:30 p.m. Brazil is expected to keep its key interest rate steady for the third straight meeting. And Anna, it just feels like as we watch these central banks today, we're all just waiting and holding our breath for CPI next week and the Fed the next day.
Yeah, absolutely. We get CPI next week, we get the Fed, Matt, we get the Bank of England, and then it feels like that'll be the last week. Is that it then, Matt? Are we all done for the year?
I think we need at least another 50 basis point hike following this coming one in order to get to 5. And then the question is, how much further does the Fed go, and what kind of damage does that do to the economy? It looks like that's the equation that the market is trying to figure out today.
That's the big question. Those are the treats that remain ahead then for the new year. That is it for Early Edition. Surveillance is ahead with Tom, John, and Lisa. They'll be hearing from Chris Barone of Strategas Research, among other voices, of course. This is Bloomberg.